This is the story of how inflation broke the logic of the finance era, and what comes next. It's a story you've never heard, 500 years in the making. Watch closely. America's financial dominance is entering an era it was never designed to survive. For 5 decades, the world was ruled by the ledger. Since 2008, it has survived on life support, cheap money, and borrowed time. But the free money cycle has reached its mathematical limit. The bill is coming due, and the rules that built modern wealth are being rewritten in real time. The system is being forced out of abstraction and into direct, programmable control. To understand where we are going, we have to trace how we got here. We trace the lineage of this collapse, from the rainy cobblestones of 16th century London to the roaring factory floors of 1950s manufacturing, into a secret, smoke-filled backroom at the Federal Reserve, past the manipulated math of inflation, and finally, deep inside the massive data centers that may soon control your life. And then, the cycle turns. We leave the era of the banker and enter the era of programmable control. And the whole story begins with a small, unremarkable object from 1951. Take a look at this pen. Do you know what it's called? You've probably seen one like it before. You may not know its name. But in 1951, the name was common knowledge. The brand was as recognizable as Apple is today. If a man wanted to look like he knew exactly where he was going, he carried one of these. It's called a Parker 51. Parker was typical of the best American companies of the time, run by engineers, not financiers. Decisions were made on factory floors and drafting tables, not in accounting offices. Value meant things that worked, lasted, and could be trusted. Manufacturing wasn't a sector of the economy then, it was the economy. But there's a bitter irony here. Because in 1951, this very tool, this emblem of American manufacturing, was used like a scalpel to sign a document that quietly dismantled that world. A document that didn't end American manufacturing, but rewired its incentives. From that point on, financial control became more profitable than production, and American business gradually learned to reward leverage over labor, accounting over craft. After this, over decades rather than years, manufacturing began its long, secular decline, from nearly a third of U.S. GDP to less than 10% today. Meanwhile, finance, then only 2.8% of GDP, would grow exponentially. And the extraordinary thing is, this wasn't an accident. The outcome was designed. To see how, you have to go back to the moment the trap was set. On the marble steps of the Federal Reserve, in the gray, 42-degree drizzle of a Washington winter. It was there that the makers finally lost to the bookkeepers. March 1st, 1951. Washington, D.C., 9:30 a.m. A light drizzle turned Constitution Avenue into a gray haze, clinging to wool overcoats and felt fedoras. Men moved briskly up the marble steps of the Eccles building. Inside, a meeting was about to begin. It wasn't dramatic. No raised voices, no cameras. Just men around a table, papers neatly arranged, decisions framed as technical necessities. What was decided in that room didn't just shape American paychecks and savings. It quietly reshaped the financial terms of the entire world. The man leading the charge is 55-year-old John W. Snyder, the Secretary of the Treasury. Snyder isn't a cinematic villain. He's just a Missouri banker who happens to be the president's best friend. He isn't writing the script, he's executing it. And beneath it all sits a monster. $250 billion of unresolved World War II debt. To Snyder, that debt is a ticking bomb with only one fuse to cut. Keep interest rates pinned at 2.5%. For that to work, the Federal Reserve has to be a good neighbor, holding borrowing costs down so the government can keep spending. Snyder even goes on the radio, publicly announcing that the Fed has already agreed to the deal before they've said a word. It's a high-stakes squeeze, a claim designed to force a surrender. Across the table sat 57-year-old Thomas B. McCabe, chairman of the Federal Reserve. A Maryland native and lifelong business executive, he spent decades leading Scott Paper Company, transforming it from a regional mill into a nationwide manufacturing firm, before being tapped to lead the Fed. He knew that heavy government spending paired with artificially low rates would hollow out the dollar. What they were really debating, though no one said it outright, was whether to preserve the value of wages and savings, or to quietly tax them through inflation to make government debt manageable. By Sunday morning, the Fed gives way. The Eccles Accord is signed. Framed as independence from the Treasury, it quietly removes the final constraint and opens the door to a system where debt, not discipline, sets the terms. In the years that followed, nothing seemed to happen. Factories ran, paychecks arrived, the country boomed. But slowly, almost imperceptibly, something shifted. Making things became less important than financing them. Ownership yielded to leverage, savings to liquidity. The system's incentives had shifted. The U.S. Federal Reserve was created in 1913 for a narrow purpose: to stop bank runs by acting as a lender of last resort. It was meant to stabilize panics, not manage prosperity. But in 1951, inside that room, its role quietly widened. Europe had learned this logic centuries earlier. America had resisted it until war and debt made resistance impossible. From that moment, private savings were no longer something to be protected from political needs. They became a reservoir the system could tap, an involuntary tax. Stability gave way to flexibility. Preservation gave way to spending. What changed wasn't simply a rule or a mandate. It was the logic underneath the system. For America, that shift reversed the very principles the country was founded on. The United States didn't break from Britain merely over taxes or representation. It broke from an economic order designed to extract rent. The colonies lived inside an imperial system dominated by land monopolies, chartered companies, and distant creditors. People who produced nothing locally, yet claimed everything by law. Independence was, at its core, a rejection of an economy where ownership outranked production. That instinct was later formalized by the economists who shaped American economic thought. Adam Smith argued that real wealth came from productive labor, not from landlords who, in his words, reaped where they never sowed. David Ricardo showed that rent did not rise because owners produced more, but because scarce assets became more valuable as society around them grew. John Stuart Mill called these gains unearned increments, wealth created by social development rather than individual effort. They were not attacking markets. They were warning that unchecked rent would drain the system that made growth possible. The founders recognized the same danger, but framed it in political terms. Thomas Jefferson warned that concentrated financial power could extract wealth invisibly, without consent, making it, he warned, more dangerous than standing armies. James Madison feared factions whose power rested on permanent claims rather than productive participation, groups that would inevitably bend the law to preserve their claims. John Adams understood aristocracy not as a matter of titles, but as wealth divorced from productive contribution. Across economics and politics alike, the conclusion was the same. A republic could not endure once control became more profitable than creation. That belief became embedded in early American capitalism. Land was kept broadly accessible. Monopolies were viewed with suspicion. Finance existed, but it was meant to support production, not replace it. Rent was tolerated as an unavoidable feature of property, but it was never celebrated. The legitimacy of income rested, often implicitly, on contribution. But the argument never fully went away. Treat rent as a cost to be restrained, and capital flows toward building. Treat rent as ordinary income, and capital flows toward ownership, leverage, and scarcity. For a long time, that question remained unresolved. Until the mid-20th century, when war, debt, and global finance would force a decision. Not in theory, in practice. After 1951, that argument was no longer debated. It was settled by events. Once the system prioritized debt management and asset stability, ownership began to outperform production. Rent became income. Finance became rational within the new logic of the system. But rent at scale has always posed the same problem. How do you extract wealth without appearing to take it? And to understand how that decision became possible, again and again, you have to see just how old the mechanism really is. The blueprint appears centuries earlier, etched into the jagged edge of a clipped coin, lying in the wet cobblestones of London. This problem wasn't new. States had faced it before. Once rent becomes central, the question is no longer whether to extract wealth, but how to do it without provoking revolt. The date is November 17, 1558. Queen Elizabeth I inherits a kingdom coming apart at the seams. The man she calls upon is Sir Thomas Gresham, a financier with a cold eye for the rot beneath the surface. Formed in the cutthroat counting houses of Antwerp, Gresham understands something the court does not. Power is not found in a crown, but in the ledger. He stands before the Queen not as a courtier, but as a fixer. He skips the flattery and places 2 coins on the table. The first is a silver shilling from the reign of her father, Henry VIII. On the king's face, on the nose, the highest point, the silver has worn away, revealing the reddish copper beneath. For this, they called him Old Copper-Nose. The second coin is older and purer, but its edges are jagged. Someone has taken shears to the rim. This, Gresham says, is the problem. The first coin was the state's move. The king debased the silver, diluted it with copper, and forced it back into circulation, drinking the wealth of his people to stay afloat. The second was the people's response. And from it, Gresham explains the rule that would bear his name. Bad money drives out the good. When the state issues a dishonest coin, people respond with a survival instinct. They hoard the good silver and spend the bad copper as quickly as possible. And if they do part with the good stuff, they clip the edges first, shaving off a sliver of silver to protect themselves from the king's debasement. It becomes a race to the bottom. Gresham recognizes that the state is the ultimate coin clipper. When debts grow too large, you don't need more silver, you dilute what's already there. Fast forward to today. The clipping is no longer physical, it's digital. It happens inside central bank models and monetary frameworks, but the objective is unchanged: to protect existing claims, service old debts, and shift the cost through a currency quietly hollowed from within, its burden borne by the people who hold it. So where does that leave us? What began as a monetary adjustment in 1951 forced a reckoning with something far older. America was not built to perfect a rentier economy. It was built to escape one. The early republic rejected systems where ownership outranked production, and its thinkers warned that treating rent as income would distort behavior long before it showed up in prices. That distortion had appeared before. Queen Elizabeth I inherited it from her father, a kingdom burdened by debt, a currency clipped to survive, and citizens who adapted in predictable ways. Gresham didn't invent the insight. He simply named the rule. Scaling that mechanism from clipped coins to a modern nation required different tools, not louder ones, just broader ones. In April 1933, the United States introduced the first of them. Under Executive Order 6102, Roosevelt made it a criminal offense for Americans to own gold. Citizens were forced to surrender their good money at $20 an ounce. Once the gold was locked away, the trap was sprung. The state immediately revalued it to $35. In a single stroke of a pen, the dollar was debased by 40%. You went to sleep with $1 and woke up with 60 cents. They didn't need to clip the coins anymore. They just changed the math while you were holding the paper. After the war, the system was given structure. In July of 1944, while the fighting still raged in Europe, 730 delegates from 44 countries gathered at the Mount Washington Hotel in Bretton Woods, New Hampshire. The plan they agreed on placed the US dollar at the center of global finance, pegged to gold at $35 an ounce, and backed by the unmatched industrial capacity and military reach of the United States. Other currencies would no longer anchor themselves to gold, but to the dollar instead. For a time, it worked. Bretton Woods bought breathing room. It allowed war debts to be rolled forward, dollars to circulate globally, and confidence to hold. But it also concentrated risk in one place. As U.S. spending grew and dollars multiplied far faster than the gold locked away at Fort Knox, the system became mathematically fragile. Once claims on gold exceeded the gold itself, Bretton Woods stopped being a foundation and became a countdown. By the 1960s, dollar creation had gone global. Banks outside the United States were issuing dollar-denominated loans the Federal Reserve couldn't see or control. This offshore system became known as the Eurodollar market, not European currency, but US dollars created and lent abroad. It functioned as a shadow banking system. No physical dollars moved. A London or Paris bank could simply create a dollar loan on its books, multiplying claims on the US dollar without touching America's gold reserves. As the Vietnam War flooded the world with dollars, more of them settled overseas, accumulating in European banks beyond the Fed's reach. Dollar claims grew faster than the gold backing them. Foreign governments could see the dilution in real time and began demanding the real thing. So, on the weekend of August 13, 1971, the state made its next move. President Richard Nixon met secretly with his advisors at Camp David. They understood the arithmetic. Among them was Treasury Secretary John Connally. Months later, as foreign finance ministers struggled to absorb the collapse of Bretton Woods, Connally would put it plainly, speaking not to Americans, but to his G10 counterparts in Rome. The dollar is our currency, but it's your problem. It was a blunt acknowledgement of a new reality. U.S. monetary decisions now set the terms for the global economy, whether other nations agreed or not. On that Sunday night, Nixon went on television and announced a temporary suspension of the dollar's convertibility into gold. He promised to lay the foundations for a new monetary system. That temporary measure is now more than 50 years old. In that single broadcast, the last physical anchor was cut. The dollar became a pure debt instrument, a ledger entry backed by nothing but the state's ability to keep the system running. For a time, it held. But by the late 1970s, the ghost of inflation grew too loud to ignore. Prices were screaming. Confidence was failing. Enter Paul Volcker. He did the unthinkable. To save the dollar, he drove interest rates toward 20%. It worked, but it revealed a new constraint. A state can tolerate high interest rates, or it can carry massive debt. It cannot do both. So the system pivoted again. If inflation couldn't be reduced, it had to be measured differently. By the mid-1990s, the machinery required a new layer of insulation. Economists call it measurement drift. Take food prices. If steak doubles in price, the models assume you'll switch to ground beef. This is called substitution. Since your grocery bill didn't double, the statistics conclude your cost of living stayed flat. But what's really being measured isn't the life you want, it's the compromises you're willing to make. Then there's hedonic adjustment. If a new phone costs more, but the processor is faster, statisticians record the price as having fallen. Technological progress is used to offset monetary decay. Add in owner's equivalent rent, a model-based estimate of housing costs rather than the rent people actually pay, and the basket is further smoothed. By weighting inflation toward electronics and away from shelter, the system can report a stable 2% even as the costs of survival rise. Since the 1970s, productivity has surged while wages stagnated. Home prices climb from roughly 2 times median income to more than 6. Because asset prices sit largely outside official inflation metrics, today's workers struggle to afford on two incomes what a single income once could. So where did the missing value go? It wasn't lost. It was redirected into asset inflation, government debt, and the financial sector. Finance, which once acted as the high-octane fuel for the factories of 1951, had evolved. It was no longer a tool to fund production. It had become an engine of extraction, turning more of the economy itself into a source of rent. By 2008, the system finally buckled. But a full reset was politically impossible. The response wasn't a cleansing fire, it was a rescue. Central banks cut interest rates to the floor and reached for quantitative easing. By purchasing massive quantities of treasuries and mortgage securities, they aimed to force down long-term rates and hold the market steady. It was marketed as stimulus. But mechanically, it was the creation of central bank reserves used to absorb risk and keep the pipes from freezing. And that is the part most people missed. After 2008, money stopped behaving like a thing and started behaving like an operation. It became an administered system of guarantees, collateral, and backstops. Which is why the true monument of our era isn't a mint, it's a server farm. Because the ledger now has a home. When the economy runs on ledgers, control means infrastructure. It means data centers and clearing systems. In the first 3 quarters of 2025, AI-related investment, centered in these data centers, added nearly a full point to real GDP growth, accounting for almost 40% of overall growth. But the deeper issue isn't the growth, it's the dependency. Modern finance doesn't run on banks alone anymore. It lives within a small circle of hyperscalers whose data centers host the critical systems for payments and risk management. When a handful of firms own the pipes, they inherit the weight of systemic power. In 2008, too big to fail meant banks. In the next regime, it means the infrastructure that banks and states can't function without. These servers are the new marble steps of the Federal Reserve. They aren't just storing data, they are the physical logic gates of the economy. And home is power. And right on cue, the backlash arrived. In 2009, Bitcoin's first block was mined. It wasn't just a new asset, it was a philosophical counterproposal. If the state's answer to crisis is to expand the ledger, then we must build a ledger no one can rewrite. But crypto didn't replace the system, it forced it to evolve. Once value moves as software, the state needs software-grade governance. We saw this during the explosion of the money supply between 2020 and 2022. When M2 surged by 40%, the old narrative collapsed. Crypto's role clarified. It wasn't an escape hatch, it was a liquidity barometer, moving in lockstep with the very system it claimed to flee. Today, the world has split into 3 tracks: the legacy system, the crypto exit, and the third track, absorption. This is where the data centers become the ultimate tool. By moving money onto these centralized, high-speed rails, policy stops being a rate and becomes a rule set. It gains the ability to make money conditional. We have arrived at a present that can't tolerate true austerity or true inflation. So, it is reaching for the one thing it hasn't fully tried yet: programmable money. And once the infrastructure exists, the next step isn't printing, it's permissions. The next system already has a name: central bank digital currencies.